ahead. Okay. Awesome. Hello, everyone. Thanks for joining in. I'm Purvi, HBS MBA 2021, and currently an early stage investor at Elevation Capital. I want to welcome you to the 4th episode of HBS India Entrepreneurship Chapter. I'm personally very excited to welcome our guests for today, Mukul, Arora, and Maheshwari. They don't need an introduction, but I'll still share a small brief about them. If you are even remotely concerned about your fitness and nutrition, you would have heard about HealthCart. Samir is the founder and CEO of HealthCart, a full-stack fitness destination for India. HealthCart is India's largest online health and fitness store for men and women, with the largest collection of health, fitness, and similar products. I think Samir is on a mission to keep us all healthy and make sure our nutrition needs are fulfilled. Welcome, Samir. Very excited to have you here.
Thank you, Purvi.
I think the next speaker for today is very special. I have the privilege to work with him on a regular basis. Mukul is the co-managing partner at Elevation Capital, a leading venture capital fund, which provides early and growth capital for emerging companies in India. He primarily focuses on early stage investments across consumer tech and SaaS, and was an early investor in a bunch of category defining companies such as Swiggy, Spinny, Meesho, Unacademy, ExpressBees, and the list continues. Mukul, thank you so much for joining us today.
Thank you, Purvi, for having me and for such kind introduction.
Awesome. So I think this is the perfect investor and founder duo that we could have to get started on this topic. Jumping straight right in and answering the white elephant in the room, a question that I think everyone is asking today and comes with a lot of myths and concerns. What is really happening in the ecosystem right now? And Mukul, I'll get started with you. We've been in the bull run for the last 10 years. 41 billion was invested in 2021 just alone, almost a 17 to 20x increase in the last 10 years, right? We've increased on 100 million rounds. We've become the 3rd biggest home of unicorns in the world. But 2022 has been a pause from the 2021 extraordinary trajectory. What are the early signs that you are seeing, when you are looking at companies or the investment flow? Has the investment slowed down? Has the number of deals that you are seeing on a regular basis, a deal flow that has reduced? What is really happening? It'd be really great if you could share some light on, what you're really seeing in the market.
Sure. Absolutely, Purvi. So, see, overall, if we look at India from a fundamental economy perspective, I think overall there we are pretty well placed. If we compare ourselves to especially the Western world, we are doing well in terms of GDP growth. We are doing well in terms of having inflation under control. Crude prices have now started coming down, which is again helping us. So fundamentally, economy is in a very good place, relatively speaking. Having said that, if we look at the funding market, capital flows, fortunately or unfortunately, are very tightly coupled with the Western world. And there, given what's happening in the US with rising interest rate, tightening liquidity, that is flowing through to India as well. If we now break it down further in terms of how is it impacting startups, the impact is very different depending on stage of the company. So if we look at, let's say, unicorns or companies which are looking to raise north of $100 million, there I would say the market is almost completely shut. So you mentioned early signs. It's not even early signs. It's fairly mature signs now that nothing is happening in that market. And the good news is last year, given there was so much capital available, all the companies which were doing well, thankfully raised enough and more capital, and they have a long enough runway to see through this phase and grow into their valuation or become profitable, which is even better, so that you are not dependent on external funding at all. So that's on the unicorns. If we look at growth stage companies, which I would say companies who are raising anywhere from $25 million to $100 million, there the market, I would say, is polarized. So there are some companies which are very exciting, very few of those which might not even need to raise. They might have enough capital, but they are still getting a lot of investor love because investors do want to back them, and they are willing to even pay a premium to get into those companies. And those, I would say, are probably 5-7% of companies in that range. And then there's a vast majority where it's similar to unicorns. Maybe they have enough capital to grow into their valuation. Otherwise, they are finding it hard to raise. The good news is if you look at early stage companies, there the market is still very robust. So there overall there is a clear decline in deal flow. and there are multiple reasons. If you are a founder or if you are someone who wants to be a founder, maybe in this kind of market, you would have second thoughts that, hey, should I start up, should I not? And then that translates directly into number of founders we are meeting and therefore number of companies which are getting funded. So there is a decline in deal flow. But if I look at high quality founders who are coming out, they are raising capital very easily. They are still raising capital on similar terms as last year. So it's not as if valuations for a seed round or series A out round are very different. It takes a little longer. So last year, I think it was honestly quite crazy when term sheets were getting signed in like 2-3 days. That's not happening anymore. It takes 2-3 weeks to raise those rounds, but high quality teams are able to raise capital. So for aspiring founders, it's as good a time or maybe better time than any. And they're stating the obvious, but all the early stage VCs raised capital in last 6 to 12 months. We at Elevation raised our largest ever fund 4-5 months back. All the other top tier funds have raised. So there is enough and more capital for early stage companies. So that's how I would break it down for companies at different scale.
Got it. So Mukul, the takeaway there is then that there's a lot of dry powder available in the market, and for the right founder, there's just enough capital at an early stage.
Yes.
Just wanted to follow up that question with another one, that is there any sector specific insight there as well, that, some sectors still booming versus some actually, seeing these signs and this impact a lot more, even at an early stage?
See, if we look at sector level, for us as investors, it's largely driven by which are the sectors which founders are gravitating to. As a VC, we would very rarely shape which sectors get capital and which sectors do not get capital. And if I use that lens, right now, most of the action we are seeing is in SaaS. More than half the companies we are meeting in early stage in seed series, they are in SaaS. And I can understand why that's the case. One, obviously, that opportunity set has become much larger in last 3-4 years. Before that, it used to be largely consumer tech or fintech companies going after the domestic demand. But I think last 3-4 years, SaaS has hit escape velocity clearly. Second, more so in this environment, where people might feel it or not might feel it is harder to raise capital. You want to start businesses which are more capital efficient. And SaaS, by definition, ends up being a lot more capital efficient. You need a few engineers to build a product. You roll it out. You start getting revenue pretty early in your journey. It's a high gross margin revenue. Unlike most consumer businesses, which have a longer gestation period, which need much more capital upfront, and therefore founders might shy away from that area. So SaaS is by far the largest bucket, followed by, I would say, fintech, where also it's more B2B fintech, people who are trying to build infra type of plays, rails for fintech, followed by other spaces like consumer internet, D2C brands, etc.
Thanks, Mukul. Somebody wanted to shift this question to you slightly in a different format. But in the last few years, if we see, right, there has been a rapid digitization and maturing of the Indian startup ecosystem itself. More funding is flowing in, more IPOs are happening, the pace of unicorn creation has expedited. How do you feel about the recent slowdown? Has this affected your company in any way, or the way you were operating in the last few years?
Sure. I think Mukul really broke it down, and it completely depends on the stage of the company. Fortunately for us, we've been trying to build a consumer D2C platform of multiple brands. And our scale has also gotten to a reasonable scale where we were anyways chasing profitability. So to be honest, like from a long-term perspective, nothing has changed on our end. The only thing that has changed is the whole capital raising cycle has increased substantially, at least by 30-40%. And obviously, we have seen that we were hit with multiple macro changes. You had Omicron in January, then you had war. So a lot of these macro uncertainty has increased the capital cycles. So for you as a founder and a company to plan for your runway and capital allocation has become a lot more tighter. And obviously that also is in a way good for companies because you are able to focus on the core bets. But from our perspective, the good thing is demand is actually going up and up, and we have been surprised with that. So we have gone almost 3x pre-COVID levels. And so consumer demand is very, very strong. Our scale has increased. We are closer to profitability. Only that the capital planning that we've done had basically become more tighter. So that's from our perspective. Now, having said that, if we were relatively smaller compared to our current size, then I can see the challenge, because we were very dependent on capital to sort of take the next step. And also our model is also not very high burn. So we could still control how much we spend per month and still achieve a reasonable growth. So that is where basically a lot of soul searching would have happened. But fortunately, we are in good shape.
Awesome. Thank you, Samir, for sharing that, internal insight. Mukul, I think I'll shift back again to you and what you said. I would love to know what we are focusing at Elevation right now, and what is the advice that you are giving to different companies at different stages in the portfolio. For example, as you had said that, in the late stages, the funding is definitely difficult now, but in early stages, there is a lot of funding. And as Samir said about, focusing on the profitability, but they've been doing it for a long time. Is this the lens that you are giving to your portfolio companies at this point?
Yeah, no, absolutely. I'll just build further on what Samir said, and also the answer again is different by stage of the company. So if I again look at scaled up companies, there the obvious part is to cut burn, have enough runway, have at least 3 years of runway, but that by itself is not enough. Few other things which are very important to keep in mind while you do that is one, what I've seen historically is when companies go into this cycle of cutting costs, customer experience goes for a toss. And I think all of us experience that in ride hailing. Now, obviously, it has gone at a very different level. But in early days, when these companies were trying to cut down their cost structures, customer experience completely went for a toss, and it's been all downhill since then. So how do you make sure that while you are cutting costs, you are being very, very cognizant that customer experience is not getting degraded, because otherwise you are losing out on long-term value. That is one. Second is, at this time, it's a great time to test all of your assumptions which seemed risky in the past. So the most obvious one again is marketing, where when companies are growing, they feel that, hey, my CAC is X, let's say 500 rupees, it's great. Let me keep spending on marketing as long as I can acquire customers at 500 rupees. But now is a great time to say that, was that 500 sacrosanct? Or should it have been 150, 200? And most companies realize at least half of their marketing spend was inefficient. In a lot of cases, it's 70, 80%. Similarly, there is this notion that, hey, Indian consumers don't pay for convenience. Is that really true? And like we saw in Swiggy, when in that first wave of COVID, when anyways orders had gone down significantly, the idea was that let us charge convenience fee on most orders. It's hard to get delivery fleet on the ground. And after that, that convenience fee has never gone out. It's always been on the platform, because we realize that if as a platform you are creating value, consumers will pay. So test all of these assumptions, which earlier people would have felt that, hey, what if I take it out? What if my growth stalls? So that's the second input. And third, I would say, is also striking the right balance between experimenting too much versus just focusing on, hey, what's our core and let's get it deeper. Now is not the time to do too many crazy experiments in a resource constrained world. So make sure that in our core, we are strengthening it. In the core, we are also focusing on building long-term defensibility versus trying to expand into too many new areas. So for scaled up companies, that those are the 2-3 key messages, but definitely ensuring you have at least 3+ years of runway. Ideally, if you can get to profitability with the cash you have in the bank, nothing like it. If I look at earlier stage companies, and here I would say companies who are Series A+, there what was happening last year, and it always happens in a crazy market, is that because you are in that constant fundraising cycle, you raise a round, you want to hit certain metrics to raise the next round, and there are 5 companies in your category. So you are on that treadmill. And while you are on that treadmill, sometimes PMF, product market fit, keeps getting pushed out. And there might be companies which are at 100 million, 500 million valuation, but they don't have product market fit. Now is a good time to step back if you have that 2-3 years of runway and say that, hey, do we really have product market fit? If we don't, no one is going to look at your numbers for next 12 months. So don't worry about month-on-month growth. 12 months out, if you are at half of current scale, but at stronger PMF, you are better placed. So now is a good time to ask that hard question with hand on heart that, hey, are we really creating consumer value? Do we really have product market fit or not? And if not, aligning your board, aligning your team and making that hard pivot. And you'll be much better placed to do that now versus 12 months out, having half the capital in bank at a larger scale and still no closer to product market fit. So I know it's very hard, much easier said than done, but for a lot of these companies, that is going to be very, very critical and will really sort of determine from the younger cohort of companies when the next upcycle come, which companies really break out. So that's how I would Purvi advise scaled up companies versus earlier stage companies.
Got it. Mukul, I'll ask a very hard-hitting question here because you spoke about the frenzy funding environment, right? And a lot of companies raised money, they were on a treadmill to compete. Are we concerned that a lot of companies might not be able to raise the next round at this point, especially the companies that, raised in the last few months or last year?
See, it's not hard hitting, to be honest, because fundamentally, a lot of startups will not raise capital, whether it is upcycle or downcycle. That's the reality. The good news is that in this market, companies will have time to get to PMF. So someone who is raising a 3 million seed round today is so much better placed than someone who raised 3 million seed round last year, because now they can quietly work over next 3, 6, 9 months trying to find PMF. So they are actually much better placed, and therefore for companies starting today, failure rate will be much lower, even though raising that first round might be relatively harder versus companies which were starting at the same time last year, even though they might have raised 3, 10, $15 million much faster. So there will be companies will shut down in every cycle, there is no doubt. But actually companies starting today will be much, much better placed versus those which started in the frenzy last year.
Makes a lot of sense. So, turning on to you, like in the current macroeconomic environment, right? Have you started seeing any change in the consumer behavior itself? Given that you are the closest to the consumers, what kind of changes are we seeing? Are we seeing any consumer categories scaling up versus a certain categories actually sinking in because of the economic environment right now?
Sure. So I can obviously talk about nutrition because that's where we focus on. And we started almost 10 years ago. And I think that's one of the learnings is as an entrepreneur, you can't time this market, but you're looking at the macro trend. So what we really believe is finally it could be post-COVID, it could be just the macro changing. But we think that nutrition category particularly has hit the inflection point. And if I broaden this out, I think working from home and people getting more time to reflect on how they spend time, et cetera, has led to a couple of things from a health and nutrition perspective. I think there's a clear part of the wallet, health wallet, which has become significant for people. They're also willing to invest in well-being products. So what we have seen is earlier on, it was all tablets, capsules and all that, and the supplement was sort of not mainstream. Now, basically, we are able to do a lot of fortification of these products and make them into healthy eating products, and we've seen a massive uptake of that category. So, generally speaking, that is one thing that we've seen, that the whole fitness and well-being adoption is definitely happening. The second thing that we've seen is obviously post-COVID, the assumption was everything will go online. And we had a footprint of 115 odd stores, and we had to shut down 20, 30 stores because we were not sure. But finally, while the online penetration has accelerated, but stores are back in full swing. So we are currently at 130 stores. So the whole model on omni-channel seems to be playing out. And from a consumer behavior perspective, the last thing that I would like to say, especially from a D2C context, is the whole creator economy is very real. And the whole marketing paradigm has changed. And I've witnessed this in the last 4 or 5 years. What used to be mass marketing has become a lot more targeted. And frankly speaking, in today's day and age, I believe that creating categories from scratch is possible, which never used to be the case a few years ago. So these are the 3 or 4 buckets where I see that consumer is getting impacted, marketing paradigm is shifting, and that's what I'm seeing.
Got it. And Samir, Mukul, you've been in the industry for so long, right? And you've seen various cycles like this, whether it's like 2008 or 2015. Is there any parallel that we can draw? Because that's what we keep hearing, that, this is what happened in 2015, this is what happened in 2008, and then we still grew. Is there anything that we can draw parallels from and advise people who are starting up at this point to be cautious about, or to do something or not do something?
Maybe you want to go first?
Go for it, Mukul. I think you'll have a better perspective on it.
Sure. So actually, Purvi, I'll be repeating what I said in your previous question. See, 2015 was a much more miniature version of this cycle, I would say. This is there, both the upswing and the correction were much smaller, also very limited to the hyper local O2O is what it was called in those days, those type of businesses. And also the market bounced back very quickly. This time it's unlikely that the market is going to bounce back, and I'm referring to the more global capital markets. It doesn't seem like it's going to bounce back in a hurry. It seems like I had seen this recent presentation by Kotu, which is a US-based hedge fund, and they pride themselves on their depth of research. And it was actually a really insightful presentation. And it feels like we are still in first third of this correction, and there is still some way to go. And therefore, if you are an existing founder, you should not be counting on capital coming back to market too quickly. You do need that 2-3 years of runway, but more importantly, as I said, I'll be repeating, but that focus on product market fit is extremely important. That how do you, and if you are a Series A company, seed stage company, for you, runway is like, whether it's 2 or 3 years, it doesn't matter. Even if you have to spend a little bit more, let's say, on building out your engineering team, or if you are building a two-sided marketplace, the two-sided marketplace can only work at a certain scale. So then don't be shy of spending on marketing. You do need to get to that critical mass and focus on getting to that PMF as quickly as possible. For those early stage companies, you will be able to raise funding in even next 6, 12, 18 months.
Sure. So I think my perspective on this is because, to be honest, as an entrepreneur, you can't time these things, right? And while you are in the middle of execution and adapting to the macro situation, it is impossible to kind of figure out whether this is 15 or 20. The only thing that I see is, you just have to focus on making sure that your long-term vision that you're trying to build, you're true to it, and maybe you just have to tightly sort of manage the oxygen or the cash available to you, which is what you can control. The other perspective I have is basically I categorize the companies into sort of 2 large buckets. One is something which is winner takes it all. Capital is a major advantage while you're going through that hockey stick. And the other could be, I would say, steady compounding, where you have time and you can control these. So it's very important for you to identify which bucket you are in. And if you are in the winner takes it all market, I think you really need to focus on maybe 1 or 2 things and make sure somehow you are able to sort of manage your resources to be able to get there until the next cycle. If you are on more, steady compounding kind of a business, then basically you can just stay the course. Obviously, you can be disciplined about spends and all that. But I personally think that these are 2 big buckets which can allow you to adapt your strategy in these kind of situations.
Got it. Samir, Mukul, I think this is super helpful. And I know that the sentiment is a little somber right now in the market, but I think all of us, at least on the call, are super excited about the India growth story. I think barring the sentiment right now, would love to get your thoughts on how the Indian ecosystem has changed over the years. What are some of those levers that you think are really working for us? We have IPOs now, we are giving exits to investors. Things are happening really fast. What are some of those things that have really helped the Indian ecosystem?
Sure. So I think, look, we started 10 years ago, and I distinctly remember when we were operating out of home, and we were trying to recruit somebody to kind of join us. He was like, why should I work for a startup? So we have come a long way. And I think it has gone through almost 3 stages. It is like, what is startup? To startup is cool. And now finally startup is real. So I really feel that, and the big change that has happened across these 3 stages is there finally we have some success stories, we have exits, we have companies which are public. So you can actually see that basically startups are just not on paper, they're actually happening. So, and then beyond that, I think it is the consumer story, it is the economy, it's the macroeconomic situation which is playing out. And you have a good sort of critical mass of investors, entrepreneurs, and the ecosystem which allows you to sort of take a plunge. And today, if you were to drop out of college or maybe finish college and directly jump into entrepreneurship, your parents will most likely not ask you, what are you doing? So I think it's just a combination of us coming to an age and macro supporting Indian growth story. That's my view.
Yeah. No, I'll just add a couple of more points. By the way, coincidentally, Samir and I both entered the Indian tech ecosystem at the same time. So I started in 2010. I distinctly remember our first meeting in our old office when you guys had just started. So I'll just add few other points. See, I think overall, if I go back to 2010-12, right, and Samir, my sense is you would agree. I don't think anyone would have expected the market to come as far as it has, and I'm just talking about the broader Indian tech ecosystem. So many, obviously in India, you will always have negative surprises, there is no doubt, but so many positive surprises have come along the way, whether it was Geo and how that spread internet penetration across the country, whether the kind of capital flows we have seen into India over the last few years. I don't think any of us expected this is the depth of capital which will come to India. Or it is the scale of SaaS companies that we have seen getting built out of India. So again, in 2010-11, we were always bullish on the India consumer growth story, and that has obviously played out. At 10 years back, e-commerce market in India was around $2 billion. Today, it's like 60-70 billion. But SaaS revenue at that time was less than $100 million for all companies put together, which is now north of $5 billion. And as I was saying, now it's hitting that escape velocity. So none of us expected SaaS was going to be such a big opportunity. If you look at online ad market, it used to be sub $100 million. And whenever we would look at someone trying to build a social platform or content platform, the first question was, ki, yaar, ad market hi nahi hai. So how will you build this business in India? I don't think anyone will have that question today. So overall, the market has come a long way, and a lot of enablers in parallel have gotten built out, whether it is Aadhaar, whether it is UPI, again, amazing success stories which we are now taking to the world. And if we look at the next 10 years, what is going to happen is, all said and done, we are still a relatively poor country. We are still at $2,500 per capita income. Next 10 years, this will go from current levels to $5,000-6,000, and that's where a lot of consumption stories will get built out. That's where a lot of profit pools will open up. And therefore, this foundation that has been built in the last 10 years will now actually see even bigger skyscrapers getting built on top of it. And one simple data point is, if we look at tech contribution to India's GDP, today it is 1 to 2%. In US, it is close to 20%. So the headroom is massive. And as our per capita incomes go up, that gap is going to converge every year. So next 10 years will definitely be much more exciting than even what we have seen in the last decade.
I think I'll just add my 2 cents as well. Like, some interesting data point that I recently thought about was that I think network effects are finally kicking in. I mean, if you look at the unicorn founders or unicorn companies, they are giving rise to a bunch of unicorn companies now. Like Zoho came out of Freshworks. Freshworks, is generating a lot of interesting companies in India. Same happened with Flipkart Mafia, very interesting companies like Grow, CureFit, PhonePe sort of came out, and that's very interesting to see. And I'm pretty sure that most of us will see those companies coming in going forward. Samir, Mukul, I think there are a bunch of people on this group who want to be entrepreneurs now, starting to think about their entrepreneurial journey. Samir, I'll start with you because you've been a founder, you've seen that journey for a very long time. What are some of the very tactical things that you would tell them that at the beginning, these are the two things you focus on. Then after, let's say a year or two, this is what you start thinking about. And what are those common mistakes that, you would have learned in your own journey,
Sure.
and you don't want others to go through that?
So first is, I think my first advice would be don't get into entrepreneurship for the wrong reasons. So I think maybe 10, 15 years ago, it was okay to sort of, okay, let's try to do, because I want to be an entrepreneur. I think now is the age to kind of follow entrepreneurship for pursuing your passion. So if you're really passionate about a problem, that is the only way you will be able to create long-term differentiation. So, and I've personally gone through this journey. I think the purpose-driven passion is very, very important because sometimes you get impacted by what other people are doing around you. So that is one. Second, very tactical advice is have some savings for 2 years so that you don't get stressed on or stressed on compromising your lifestyle because it is very important to kind of take away those variables and just focus on the problem. And as it is, there would be a lot of ups and downs, but give yourself 2 years. And if you're able to make headway in 2 years on the product market fit, I think it would be a great outcome. If you're not, for some reason, you will also be able to figure out if this is the right track for you or not. So I think that would be second. And I would say the third one would be, which is again very tactical, is have clarity on thought in terms of what could be the best outcome for you. So basically, look, the whole ecosystem of entrepreneurship is evolving. And sometimes you have not seen the full thing. So there are a lot of questions: how much money should I raise? How much should I dilute, etc., etc. And if you have at least a theoretical framework in terms of what would be a great outcome for you, and in whatever way that you want to define your success, that will allow you to sort of go backtrack and figure out that these are the many milestones that I need to work on. So I think I'll leave at these three things, but these are my views.
Got it. Turning to you, Mukul, these founders will also look for very high quality investors. So would love to understand for this group that, what are you looking for when you're meeting an early stage founder? What is too early versus not? What's the right time to start thinking about funding? Whether it's too early, too late? Any thoughts there?
Sure. So what we would look for at an early stage, I would actually just build on the first point which Samir mentioned around passion for that space, and the way it shows up is usually that I've seen founders who become very successful in early stages. They have some unique insight about customer or market, which most founders would not have. And oftentimes it's a very simple insight. I'll take an example of Swiggy. When we invested in Swiggy in 2015, by that time we had met at least 50 food delivery companies in India. And Harsha, who's the Swiggy founder, was the first founder to say that, hey, if you have to build a successful food delivery business in India, you have to own logistics. You have to have your own delivery fleet. Today, it seems so obvious. Everyone has that. But at that time, everyone was just looking at the West, and there were these companies like Just Eat and Grubhub, which were largely ordering platforms, and then restaurants would deliver. In India, the reality is most of the restaurant market is unorganized, and therefore restaurants don't have the capability to deliver. So it was a very simple insight. But that insight, even at that early stage, showed up in how they were able to, even at that time, charge a convenience fee when they were live only in Kormangla. It showed up in how they were seeing customers coming back to them and ordering at a very high frequency. So that is something which personally I value a lot. That is the founder coming to us with some very unique insight. And that comes either from a place of passion, like Samir said, because they've thought so much, they've gone so deep into experience. So there are a lot of things I would look for in a founder, but this usually I've seen swings one way or the other for me personally.
Got it. And Mukul, just on the early part, is it too early to raise at some point, or you should wait a little bit, get some traction, and then go out and raise and talk to investors? Any thoughts there?
See, from a founder perspective, the only thing to think about is that am I committed to this space and am I committed to being a founder? That's the big question. And sometimes what happens is that you jump in and you say that, okay, let me try it out, which is fine. There is nothing wrong in it that you want to explore, you want to test out the space, but at that stage, don't raise capital because it's early. And once you raise capital, then you are kind of stuck that now I've raised, I have to get to a certain scale, raise the next round. So first, take that time, be sure that, hey, I'm in it for next few years, not in it as in the exact same market, not in it as in the exact same idea. All of that changes with the journey. But I'm convinced I want to be a founder. I'll stay at it. If you are there, and obviously if it's fundamentally a business which does need capital for you to get off the ground to get to a certain scale, then it's never too early. You should go out, have those conversations, whether it is with angels, seed funds, larger funds like us, and try and raise.
Awesome. So I think the takeaway there is that it's never too early. Once you have the idea, it's never too bad to start having the conversations and get conviction on the idea itself. Samir, Mukul, we've been having a lot of live questions, and some people have sent us the questions beforehand as well. So I'll start with the skeptical question that Khalil had. In the current macroeconomic environment, is it just capital tightening or correction to sanity as well?
Both go hand in hand. I think when there is surplus capital, there is surplus craziness as well, and then other way around, and both are important. I would not for a moment say one is better than the other, because you do need those up cycles for people to try out things which would have seemed crazy, but in those markets they started and actually they've turned out to be very well. But only those markets would have given them that risk capital. Also, those markets are important for you to drive consumer behavior. Driving new consumer behavior does need subsidy. It does need you to incentivize that behavior for some time, which cannot happen in a market like this. So that those cycles have their own value, and these cycles have their own value where you see survival of the fittest. So if there is a category or a type of business which does not make sense, so going back to that 2015 example, there were a bunch of these bus aggregators which had come up. None of those exist today. So if a business fundamentally did not make sense, they will get cleaned out. If you look at a category which becomes very cluttered, food delivery was one example, local services was one example, they will consolidate towards winners. So future capital, talent will go to those winners. And third, fundamentally, goal of every business is to make money. So at this time, you then say that, okay, now we have proven a lot of things, but now let us also prove fundamental viability of our business. So it definitely means return to sanity, which is as important as the upcycle parts that we were seeing over the last few years.
All right. Samir, there's a very specific question for you from the audience as well, that how do we replicate the success of HealthCart in the Middle East? If you have any suggestions for them.
So by the way, there's already a couple of models in Middle East which are following HealthCart model. I think the unique thing that has worked for us is basically a combination of HealthCart, which is essentially a marketplace model, along with a very, very strong sort of portfolio of brands, because one makes the other sort of work and the other makes the first one work in the early stages. So I haven't seen that combo model anywhere, but in Middle East, there are a couple of either marketplaces models which are successful. But look, if you're passionate about it, go for it. I'm sure it can be done.
Makes sense. I think there's another interesting question that actually Faria asked. As startups get ready for the long funding winter, how will these conservative times sort of change talent retention and ESOPs? Because we're definitely seeing and hearing a lot of news about retention and obviously firing and hiring both. What are you thinking about in terms of ESOPs, in terms of retaining your talent? Love to get your thoughts, Samir.
Sure. So I think, the whole ESOP is a very, very strong tool. And also, we have seen ESOPs evolve over time. It used to be very, very concentrated for few people. Now, I think if you were to start fresh, it is a lot more widely distributed. So I think about company, talent in two or three buckets. One which is very, very core, and this core is almost like a founder equivalent talent, and they have to be with you from a long-term perspective with thick or thin, right? So they are working there for the purpose, and they should have the equity exposure to be able to sort of see the outcome. Then basically there are, I would say, the high potential talent, which has the potential to sort of rise up to the occasion and all that, and they are deeply committed. And there are people who will work like founders, and these are the people that I'm talking about. And then the third bucket is basically where you need a lot of, let's say you're operationally intensive, you have full organization running and all that. So I think our strategy mostly, the way we think about this is basically, look, there would never be enough sort of ESOP food available for you, but you should be generous about it, and you should have strategies for these different segments, because the whole motivation level and what people are trying to do at these different segments is also very different, and it has to align with your ESOP policy. So that is the way we think about it. And fortunately, at least on the senior leadership level, we have strong retention, and there's a strong alignment for people to see if we can basically take this company to the next level, and they are fairly committed. So I think it's an iterative process, but definitely that's how we think.
Great. Mukul, would love to get your thoughts on this as well, because you work with companies across different stages, early, growth, late. Is the current environment in any way changing the way we look at talent retention or ESOPs?
Yeah, I don't have much to add to what Sameer said. One point I would reinforce is that in these times you have to be over generous with ESOPs, because if you put yourself in a candidate's shoes also, they are taking more risk today. At least the perceived risk will be higher in joining a startup today versus, let's say, last year. And the other good thing about ESOP is you have 4-year vesting. So if the company is around 4 years out, and if that team member is around 4 years out, they would have added immense value to the company. So therefore, be generous with ESOP. Second is in times like this, especially if you are an early stage company, it gets very hard to hire seasoned professionals, and therefore don't try to hire someone who's already a VP somewhere or a CXO somewhere. If you have a very strong personal relationship with someone, it can definitely work, because they'll take a bet on you as an individual. Otherwise, look for young, hungry, fundamentally smart people who have 2-3 years experience. If you want, for example, someone to come in and lead bunch of categories for you, look someone who is leading a subcategory or subcategory in some other company but is a fast riser. So look for fundamentally strong first principles people who are young, hungry, driven. It's easier to get them on board versus seasoned people. So those are the only two thoughts I would add.
Got it. Makes a lot of sense. I think, Mukul, there's another specific question that has come up for you. It's on a specific sector that people think that clean tech and sustainability sector are not the most capital efficient markets. So what are your thoughts there? Are you open to investing? Are you looking at those companies? People would love to get your thoughts on it.
So caveat is that I personally haven't spent a lot of time looking at that space. With that out of the way, see, overall, if you look at globally, the amount of both capital and talent that is going in the climate tech space, clearly there is a very strong tailwind. There is no doubt about it. And historically, it's been very capital intensive, because it's been about building physical infrastructure, physical assets. But that is changing, because now climate tech is not just about the new technology for building either solar power, wind, etc. Every company is moving in that ESG direction, and therefore they need tech to help them track better, monitor better, report better. So therefore, there is a large SaaS opportunity which is now coming up in the whole climate tech space, and that similar to any other SaaS business is very, very capital efficient. So I think more opportunities will come in. I'm not an expert in that space, but even in India, this space will see a lot of activity over next 5, 7, 10 years compared to what we have seen in last few years.
Makes a lot of sense. I think the biggest macro question that has come up, and I would love to get your thoughts if you have on them. How will the world change in the next year? Is there something that we can predict? Is there something that we can prepare ourselves for?
So there is this person called Howard Marks, I think I'm getting his name right, who runs Oak Tree Capital. And he says that there are two types of people in this world. One who think they can forecast the world, but they are wrong. And second, who don't think they can forecast the world, and therefore they don't even try. So I'm in the second category. I don't, especially in this sort of phase where we are seeing so much uncertainty. I don't think next 12 months anyone can forecast, nor should you try to. And the beauty is, as an early stage founder, next 12 months don't matter. That's the best part. That 12 months, so yeah, you need to get to very early signs of PMF. So you will start building your early team. You will raise some capital. You will do some experimentation, and 12 months will be gone. So don't worry at all. Don't think about what is going to happen in next 12 months. If you think what the idea you have or what you are trying to build will be there 3, 5, 7 years out, now is the right time to build it. You should not worry about what's going to happen in the next 12 months.
Samir, would you like to predict the world?
No, absolutely not. but I would really second the thought that getting into entrepreneurship, you just can't time it. And if you're especially thinking early stage or starting out, you really have to have 10-year view on these things. And it's like almost like investing in the stock market when the stock market is lower. Then none of these things will matter in the long run. So I would really jump in if you're thinking about a startup and if you are passionate about a problem. I don't think you can go wrong in the next 10 years. A lot of things have to fundamentally go wrong for things to go south.
Absolutely. I think there's just another question that just trickled in, and I'll take it because we still have a few minutes. But Mukul, Samir, if you have thoughts on how should companies think about listing in India versus the US? People are always, founders are always thinking about it. How do they go about it? Do you have any thoughts there?
See, historically, there used to be a view that if you are a tech company, listing in US is better given there is a lot more capital available there. The kind of the investors there are more nuanced and they know how to value these businesses. I think that has completely changed in last 3-4 years. So now it's completely a function of where your market is. If your market is largely India, I think India is a much better market. All the global tech public investors are now investing in India. In fact, companies who are listed on Indian markets are trading at a premium to their global counterparts, because what happens is, let's say if you are a food delivery company listed in US, you will be the 7th company listed there, much smaller than everyone else. People won't even understand that, hey, at $4-5 average order value, how does this business work? US market is very different. Versus in India, those ground realities are much better understood. So if your market is Indian market, it's much, as in the consumers are in India, it's much better to list on Indian indices. If you are a SaaS company, for example, going after global customer base, largely US customer base, US could still be a very good option, given that is a very strong sign of credibility when you go sell to large enterprises. So that's how I would think about it.
Samir, is this a question that you have thought about or heard from a bunch of founders as well?
So to be honest, I'm still in the discovery phase of how this process works. But logically, what makes sense to me is wherever your customers are, or let's say 70-80% of your business is domestic, I think it is just easier to keep things simple and basically just list if you have enough demand. Now, what used to happen in India, there was no, literally until 2 years ago, there were no new age companies, right? So I'm assuming the understanding of how these new age companies work, maybe there would be still be loss making, etc., etc. These things are changing, and now you have several precedents in terms of companies getting listed successfully. So I don't see any reason why people should go until your customer base is somewhere.
Awesome. No, makes a lot of sense. I think we're all seeing a lot of different journeys right now. Still early in that ecosystem, I guess. Samir, Mukul, I think we're almost at the end of an hour. Any closing remarks for our audience? You guys have been wonderful. I think I personally have learned so much from this conversation. But anything that you want us to take away at the last of this conversation?
So maybe I can go first. I would say that for people who are thinking about entrepreneurship, I think definitely this is a great time to sort of jump in. If you believe in India's story and you're committed as a founder for next 10 years, the only thing that you have to be doing is, because look, investors will always have a different view on the business. I think the thing that will work for you is perseverance. Because, I think about this quite a bit. In last 10 years, if you go every year, there would be a different hot company, and that hot company would be very different next year. So you just, if you're perseverant about and passionate about the problem that you're trying to solve, and be at it for 5 years, 7 years, 10 years, chances are very, very low that you will go wrong. So don't try to time it. Don't get influenced. And if this is a passion for you, go for it. This would be a great time to get started.
Yeah, actually, I couldn't agree more with what just Samir said, and I'll share two examples, because I think both of us have said it's a great time to start, but I just want to also make it very real with a couple of examples. So one of our portfolio companies is Spinny, which is in the used cars space, and they started, if I remember correctly, around 2014, 2015. And they raised their Series A, which is where we invested in late 2018, early 2019. So for 4 years, they could not raise capital. Also, when we did the Series A at that time, the market consensus was that the used car space had already played out. So there were large companies, there was Cars24, Car Deco, Car Trade, and therefore all the models, whether it is auction, whether it is classified, whether it is building on top of dealers, everything is taken. Thankfully for Spinny, they were not able to raise capital in early days, which forced them to keep trying different models, keep experimenting. And finally, they realized that, hey, the only way to solve this problem in used car market for end consumer is by being a full stack player, where you buy cars, you refurbish them, and then you sell to the end consumer, almost like a new car company. And then you give a warranty on top of that. That's the only way you can create value for consumers and therefore capture value for yourself. And guess what? None of the large companies was doing that. And that's when 2018 they raised their Series A. And fast forward 4 years, now they are the market leaders in used car space. So no one had heard of Spinny till 3-4 years back. Today, every other large used car company is trying to tell their team, now we need to pivot and become like Spinny. Obviously, it's very hard at that scale. So therefore, and while Spinny was on that journey, they were only competing with themselves. They were not, unlike, again, if I take example of food delivery or local services, which were built in top of the cycle. So for Neeraj, those 4 years were very hard. When Neeraj is the founder of Spinny, when he could not raise capital, he was funding it from his own pocket. Like Samir was saying, he showed that resilience and perseverance. But after that, it's been a much easier journey versus founders who would have those first year and a half very easy because they are in a hot category, raise a lot of capital, but then realize, oh shit, we are either number 4 in a category which makes sense, or we are in a category which never made sense in first place. So it's actually a much harder time. It will feel like a much harder time to start, but your odds of success are much higher if you start today versus in a easy capital environment. So yeah, that would be my closing thought.
Awesome. Samir, Mukul, I think this has been an extremely enriching experience for all of us. And thanks for bursting a lot of myths for us today and, sharing your excitement about the India growth story. I think some of the biggest takeaways for me is that it's still a great time to start up. You have to be in it for the right reasons. You have to think about the PMF, and the right companies will still get funded. I think a lot of people have taken a few lessons from this conversation, and I'm going to apply to that entrepreneurship journey. But thank you again. Thank you so much, Samir and Mukul.
Thanks, Purvi.
Thank you. Thanks, Purvi. Thanks, everyone.
Thank you everyone for joining.